All right. Good afternoon, Simpler family. Happy Friday. I hope all of you are having a great trading day, a great trading week. I'm excited to be in here with you and talking with you over the next 30 minutes on the difference between mechanical trading and emotional trading. I believe it's one of the hardest aspects of trading to master the psychology behind our trades and not just negative emotions regarding trades, but also euphoric emotions regarding trades. Both tend to cause, I don't know about you, but cause me problems. And over the years, I have developed ways that allow me to trade more mechanically rather than emotionally. I'm going to give a trade example that we have on in the trendy room right now, and that is UNFI, United National Foods. We've traded this a couple times this month, both for profits. And the idea behind mechanical trading is to have a plan, execute the plan, and do not allow your emotions to get in the way. So, with this trade right here, if you don't know, I am a supply and demand trader. So, what I am focusing on is finding demand zones, which is what this green zone here is on this chart. My focus is to find a demand zone. Then buy calls at the money calls inside of this demand zone. I very often scale into a trade. What that means is I'm going to start a position at the top of a demand zone. I'm going to add to that position in the middle, towards the middle at a level inside of the zone. And then my stop is a candle close below the zone. So my trade plan going into United National Foods was to buy the $26 calls when price dipped down to 27.31. Then add more $26 calls when price dips down to 26.51. And I am wrong. The trade is not valid any longer, which means I would stop out of the trade on a daily candle close below 25.56. So this was my trade plan coming in. Now, as far as targets go, my ultimate target to the upside is 30.49 by 32.20. I The plan was to trim at 27.97 and again at 28.99 on the way to the ultimate target. So, look, here's the reality. The reality is you can have the best plan lined out, but the trick is, can you execute your plan when price pulls back to your trigger? Okay. So when price was up here, and this is actually where we exited UNFI on our previous trade this month. But when price was up here, you're feeling euphoric, etc. This was our target at the beginning of the month. This blue line was. So if you're feeling euphoric up here and then price begins to pull back, you can have some fear about taking the trade inside of this zone again. And that would be emotional trading. So allowing your emotions to dictate your trades. So when price is pulling back from the target back down into demand, If I allow my motions to dictate my trade, then I would be fearful as prices pulling back and I would not execute this trade right here in the demand zone. But because my goal is to be mechanical, I set an automatic buy at this level. How did I do that? Well, I simply went out into the option chain for UNFI. I chose a February 21st expiration, and as I told you, the $26 calls. Now, obviously, I'm in the position now, but let me show you what that would have looked like before price made it to my buy zone here. So I was buying at 27.31. So I would have went in to this option chain. I would have clicked on the option strike that I am choosing, which is $26. And I would do one of two things: either adjust this price per option contract here down. When I do that, it changes the expected price for the underlying. So 27.31 was my initial buy target. So I would go down here and adjust this price until it said 27.31 or thereabouts, right? It's not always exact this way, but it's within a few dollars, which is not a big deal to me. So that means the price of the option at the time that UNFI is at 27.31 would be about $2.22. I would hit confirm and send like that. And I would come back over to my chart and I would see my limit order in here to buy right at my target zone. So then I don't look at the chart again until I get the alert that I have indeed purchased this option at my buy zone. That allowed me, when price pulled back into this zone, that allowed me to be mechanical with my entry, and I entered the trade. No matter that I might have been fearful that price would continue to drop, what have you, this allowed me to be mechanical, fill my trade, and then today we trimmed and a second trim here at 28.99. And now I need to be mechanical on the trade. And the way that I do that is I like to use Fibonacci's to stay in my trade. So what I'm going to do is I'm going to measure fibs here from this low up to this high, and that tells me to stay in the trade as long as price is going to close above 28.10. So what I will do is I will create an alert at or below, just below that level, and put in the note a possible stop because I do wait for a candle to close before stopping out. Then I can remove those fibs, and so I will have an alert here. The note will pop up if price pulls back to 28.08. The alert goes off, and I know to be mindful that UNFI is near my stop now after two trims on the way to my target of 30.49. Create an alert up here at my next target, just below it, and write target in your note. And then when the alert goes off, it'll pop up on the screen and you know price is at target. You take your profits, you set a trailing stop, whatever your process is. For me, that would be a trailing stop here. And then I don't sit and stare at this chart all day. Setting and staring at charts causes you to trade emotionally, especially if you're in a swing trade and you want to stare at a 5-minute chart. Let me show you what that would look like on this trade. So I've trimmed twice. I am in profits. I'm doing well. And price got up here. And now we're pulling back, right? The whole market is pulling back. So UNFI is pulling back with it. If I'm sitting here and watching these smaller time frame charts for my swing trades, it can cause me to react out of fear and exit my trade and then potentially wake up tomorrow and price be at my target, but I allowed fear to creep in and get me out of my trade. And then I'm not able to collect my profits up here at target price where I anticipated it would go over the next month. So, one way that I practice being mechanical is to have a plan ahead of time, set up automatic orders to buy or to sell at entries and targets, and then I do not stare at the chart. I do not stare at my monitor screen that's given me the P&L for my positions. I simply let the plan work out. There's only two things that can happen in a trade. You're either going to win or you're going to lose. As long as you're okay with the amount that you have at risk in the trade, you trade the plan. Pretty simple, right? It sounds a lot more simple than what it is actually um, than what is actual, because we are humans, we have emotions, and in trading, those emotions are no different, especially when it comes to money or having money involved in the equation. We tend to be a little more emotional. So, what I would encourage you to do, if it is a goal of yours in 2025, to be more mechanical in your trading, set you a list of quote unquote rules that you have. Rules that you have for entering trades, rules that you have for the amount of money you're going to allocate to trades, rules that you have for trimming or collecting some profits on the way to target. Um, and then keep that in front of you, looking at it. Put your plans in place ahead of time, right? We're not just willy-nilly-ing it around and taking a trade at the last second with no plan in mind. That is a disaster. That is not something that is going to allow your P&L to travel from the lower left-hand side of the chart to the upper right-hand side of the chart. You need to have a plan. You need to execute that plan. If you're going to spend the time to come up with trade ideas, and you're going to spend the time to put together a trading plan, there is no worse feeling, in my opinion, than taking all that time, doing all that work, and then not executing it because of the emotions you're feeling at the time that price pulls back to your buy zone. You don't execute because of emotions, and then you watch your trade plan work out to perfection. Okay? That is a worse feeling to me than when I have a losing trade. Because whenever I have a losing trade, As long as I had a plan, I executed according to that plan. If I did those things and it's a loss, that's all right because we're not going to win every trade, right? It's a game of probabilities. We need to obviously, hopefully, win more trades than we lose, but not every trade is going to be a winner. If I don't execute because of my emotions, that is more frustrating to me than having a losing trade. So I encourage you to create those plans ahead of time. Know where you want to buy, know where your stop is, know where you want to trim, know what your ultimate target is, and then execute your plan according to the plan. Does that make sense? Are y'all following me there? And like I said, the way that I keep my emotions out of it is by setting automatic orders. Another way that you could set an automatic order, let's take, for example, Google. Okay. I know this is going to be a trade that I would uh, get into if price pulls back to my demand zone. So we will set up an automatic trade together on Google. Sorry, Toss is running a little slow today. All right, this is my zone. This is my buy zone right here, 197.21. If Google pulls back to 197.21, I want to start a position there. I want to add to that position at 196.09. My stop is a candle close below this demand zone. So in this case, 194.92 would be my stop. All right, my allocation per trade, and I'm not saying this is what yours needs to be, but I do encourage you to know that amount. My allocation is $1,000 per trade. So if I have two entries here, that means that on the first entry, I'm going to buy in the however many options I can buy for $500. Then at my add, I will take whatever this first entry, whatever of my allocation it uses, minus the 1,000 to get the amount that I will be adding at the add. And then the stop is simply an alert for me. Okay. I do set an alert a little ahead of time so that mainly so I can alert the members in the trendy room that a bid is getting ready to fill. So let's consider this for a trade into next week. I'm only using a 4-hour chart and I'm using these yellow lines on the chart, which are weekly edges. This one representing a playing field of demand. Demand is where buyers are waiting to step in. So that means I want to go long in demand. So my first entry is 19721 and my add is 19609. 19721. Let me write these down so when I click over to the next screen, I don't forget. Okay, so like I said, I would be using next week's expiration, January 31st. I like to buy really close to at the money when I am trading straight up calls. I trade from a cash account, so I am buying calls or I'm buying puts. Those are the only two things I do in this account. So 197.50 is the strike I will choose. Go over to the far right side and you will see a cogwheel right here. If you click on that cogwheel, a screen will pop up. This is saying that I am going to buy, and I know I won't be able to buy two. I'll be able to buy one contract when price gets to, if you click under symbol, it's going to automatically fill in Google. Click under method, mark is what you want to see. And the price that I'm looking for a pullback to is 197.21. So that means when Google's price is less than or equal to, and right here, you put in that value, 197.21, hit enter a couple of times, hit save, go to confirm and send, and it's going to pull up this screen. Read this to make sure that um, you have the right order in. So I want to buy one Google 197.50 call when Google's mark is at or below 197.21. Hold on one second because there is one thing I forgot to trade, and that is change this to market. Okay, so I am buying one Google 197.50 call when Google's mark is at or below 197.21. Hit send and the order will be in. Then my ads are at 196.09. So I'm going to go back and I'm going to hit the cogwheel again. I'm going to go to buy, and this time I will be able to purchase two and still be within my allocation. When Google's mark is less than or equal to 196.09, hit enter twice, hit save, go to confirm and send, read it. Buy two Google 197.50 calls when Google's mark is at or below 196.09. Hit send. And now I will have my orders in. Buying three total contracts, one when Google is at 197.21 and one when Google is at 196.09. Okay, so I have an alert in at the top of my buy zone here to give me a heads up so that I can let my trendy family know that I'm getting ready to get in a trade. And then it will automatically execute if Google pulls back to these levels that I want to buy at. Then the rest of my plan is to trim one of those contracts at 199.75. See this yellow edge right here? That is an upper weekly edge. And that plus the all-time high would be my target to the upside. So all in all, this plan is set in place. I don't need to sit and stare at a Google chart waiting for price to come back here, because what will happen, I know myself, and what will happen if I do that is I will be looking at a 5-minute chart, or yeah, it would be a 5-minute chart. I would be looking at this 5-minute chart and be like, okay, it's pulling back. It's getting close. It's getting close. Oh, you know what? I don't think it's going to pull back to my zone. So I'm going to go ahead and enter up here. That is emotional trading, not mechanical trading. I identified my demand zone. I identified my entry. Now it's my job to wait. Either this trade fills or it doesn't. If it fills, it either wins or it loses. The important part is, can I develop a plan and stick to that plan with discipline? Sorry. I believe if you can develop a discipline like that and you are trading a good system or a good strategy, you will find that you will have more success and be more consistent in your profits than if you allow the very, oh, sorry, the very normal emotions around trading dictate how you trade. All right. All right. We have about 5 minutes left. Does anyone have any questions for me regarding this? Awesome. Option trader asks, when you trade options, how do you apply stop loss on calls or on puts? So I'm a supply and demand trader, option trader. So my stop loss is simply if I'm trading out of a demand zone, like for the case of Google, I stay in the trade as long as Google's price stays in this demand zone. I do not exit a trade. I do not take a loss as long as the price does not close below this demand zone. Okay. Supply and demand trading can be different than some other strategies in trading. And so that's why we stress the importance of having an allocation amount per trade that you're comfortable with trading. So I don't have a real large allocation amount because what I have found to keep my emotions in check whenever I have losing trades, I have an allocation amount that allows me to do that for each trade. And everybody's amount might be different. But as far as a stop goes, how I treat my stop loss is if this demand zone, in this case, a 4 hour demand zone, if you have a 4 hour candle close below the demand zone, then I stop out of the trade. All right. And it'd be vice versa. Let's say that this was a supply zone, a candle close above a supply zone, I would stop out of a trade. All right. Zen Trader asks, yes, I stop out manually, option trader, because I commit to candle closes. If I were not committing to candle closes, then I could put an automatic stop at 194.92. But I do commit to candle closes, so it's just an alert for me. So if this trade fills on Google, then I would create an alert right here before the stop, and I would put in the notes stop on candle close. And then once the alert goes off, that's when I need to pay closer attention to this chart. All right, one more question here because we're going to run out of time. Uh, Zen Trader asks, what factors do you consider to determine your demand zones? I'm looking for inside and up candle formations, and that's what equals a demand zone for me. So no matter the time frame, whether it's a weekly, a quarterly, a daily, doesn't matter the time frame. I'm looking for these inside and up candle formations here, and that's actually a quarterly chart, believe it or not. But on a weekly chart, I'll just give you an example for Google. Sorry, toss running a little slow. An inside and up candle formation Zen trader equals demand, and an inside and down candle formation equals supply. I learned this from Trendy John in the Trendy Trading Room. And if you want more in-depth details about it, you can check out his YouTube channel or come and hang out with us in the trendy room. We do a lot of teaching every single day on identifying zones and then everything around trading supply and demand. But all right, fam, sorry if I didn't get to your question. I am out of time. I hope you have a great rest of your day and a wonderful weekend. I look forward to seeing you again here in the Essentials Room Monday, I believe. Yes, Monday. I will see you on Monday. Much love, fam.